Let's talk about some stonks. Stonks. Money talk.
What's going on, everyone? Once again, we have another episode of Money Talk, and this is RFBM, Raising the Financial Bar with Mar. So as you already know, we got the stock guru expert here. I'm just kidding. Look, that's how the disclaimer. But we have my stock guy out of everyone that I have on here.
Just be chilling.
Okay.
You know, he's trying to downplay his greatness. You know what I mean? But what do you got from me? Cuz what do you got from me right here with the stocks? What's it looking like out here?
I mean, it's looking great. I mean, indexes are hitting all-time highs. Your Dow Jones Industrial cracked 30K. S&P 500 and your Nasdaq hitting all-time highs.
Nasty face.
And when you look, we had a correction back in March. That's when like stocks, I think it probably took off like 10% overall. But you look at like the Dow Jones Industrial, it was trading at like about let's see here. Right before the correction, it was trading about. We didn't hit the 30K. And then we had a correction that started roughly about mid-February and hit its bottom the 23rd of March. And that was at, call it 19,000.
Is that the Dow you're talking about?
Yeah, that's Dow Jones Industrial. We lost about 10,000 points. It was a correction. And then now it cracked the 30K point. When you look at like past averages on the Dow Jones, in early 2000s, it was only trading around like in the teens, the 10,000 and up, and people were like having all types of euphoria. Oh, the Dow Jones had just hit 10,000. Because before that, it was trading like between 3,000 and 5,000, and then it hit the 10, and then we had our financial crash, and it dropped back down to about 7,000. So we were peaking in 2007 around like 13,000, and then we had the financial crisis, the house bubble. It popped, and we dropped back down below 10,000, and like even it went to a low of about 7,200. And then after the recovery, it's just been on a tear. Then we had a little mini correction in 2018, and then it went on a tear again. And then right before we were about to hit the 30K, I guess it was just testing its highs again, and it dropped to about 19. And then now we back up again at 30. And so I'm saying this as far as if you're not in the market, you might miss out. Like you think, okay, like financial crisis happened. You're like, you know what? I don't trust the stock market. I'm gonna lose all my money. It's gonna bounce back, and then it just goes on a bull run for over 10 years. And then we had a little correction again, and people like, you know what? Nah, I'm sending this one out. Dow Jones ain't gonna hit 30,000, and then it shoots up, and we passed 30,000. So, sky is the limit. I mean, sometimes the way I look at the stock market is that there are more and more people in this world, and technology is giving people access to multiple corners of this world, and with that, I think there comes the chance of investing in equities and companies making a lasting imprint on people's lives. And if you're not with it, you're just gonna get left behind. I watched like my little stuff on CNBC, Squawk on the Street, Market Hour, whatever it may be. and this really good wealth manager named Josh Brown, he talks about like the whole euphoria of the Dow cracking 30K, and in the past, or you see like in the 10,000s, in the teens, and he's saying in his lifetime the Dow Jones gonna hit 100,000. That would be absurd. Like if you're not investing, you're just missing out. You're missing out on chances to not only become rich but build wealth. That's the main thing you want to do. Like
Absolutely.
you will be rich. Like if you invest your money in the stock market, you will become rich. I
And
ain't
stand
guaranteeing
by
it,
that.
but you will become rich. But also you have the chance to create everlasting wealth. And if you're not putting it in, you're losing, because you already know due to inflation, you're losing 2% on your money every year, whether you have it in a savings account or you have it in a mattress, whatever, you have it in a shoebox, you're losing. So if you just sit on the sidelines and you've seen the market go up, you don't know when to try to time the market.
Mm-hmm.
And sometimes with it going on such a high run, it could be people just investing because they don't want to miss out, and that's fine too. But you don't want to be on the sidelines losing nothing. I rather gain one. I'd rather gain 1% than no percent at all. So,
Right.
but the Dow Jones 30,000, like
That's
I'm surprised we're
unbelievable.
not talking about it more. But if you look at it, let's look at the year I was born. I can tell y'all, but they might, they calculate like, okay, he was born, da da da, da, like got his name, his identity, whatever, blah blah blah. But Dow Jones, when I was born, it was trading at 3,543, and now it's at 30,000. So I'm hoping next couple of decades, the shit at like 30, at about 60. I'll be happy, and I'm kind of hoping that there's another correction.
Long term.
Long term, that's the main thing. The gal them want the length and strength.
Negro, please.
This guy.
But long term, they want it long, bro. Long term is the way to go. You ain't trying to nobody. And it's nice to get rich quick, but long term is the way to be. It is the way to be. So every week I invest my little money, and I'm just hoping to just take part in the growth. But you're seeing companies like Starbucks, like trading at like $100 a share. Wingstop, they're doing special dividend. Costco, their special dividend. A lot of companies are hitting all-time highs. Who else? One thing I want to segue from that. One thing I do want to talk about is the whole digital, like, currencies, whether it's fiat, crypto, not just you. So you have your companies like Visa and MasterCard. Those are like the two major card companies that do credit. They're like the two major companies, and with this pandemic now, they've been giving us more transparency on how often people use their credit card, or they use credit. I don't know the stats on it, but now you're seeing a lot of companies trying to get into like the digital currency space. Like people are afraid of transferring the virus through money, because it's dirty. Money is dirty. We know it's disgusting. There's a whole bunch of bacteria. So now everybody just resorting to swiping their card, tapping their card, using their phone to pay, whether it's Google Pay or Apple Pay, and they have their Visa or their MasterCard through these companies or through these apps. And so now you're seeing people use their cards more and more, and then you're seeing digital payments, whether it's through the likes of Square, Venmo, Cash App, Zelle, and now you heard about PayPal. They want to get involved with the Bitcoin, and you have your Coinbase platform where you could trade cryptocurrencies like you can on Robinhood as well. But your Ethereum, Bitcoin, your XLR, there's all types of cryptos are coming to light. Just digital currency is coming to light. I was recently listening to this podcast where they're talking about the central banks getting involved with crypto. So not necessarily that they want to use cryptocurrency like Bitcoin and Ethereum and XLR, but they want to basically take our fiat money and make it digital. So one pro to it that with this with enabling this technology for day-to-day life is kind of getting rid of the dark web. So now you see where cash is being exchanged hand over hand, whereas Jimmy just can't go take his little $50 and go buy some fentanyl, and you don't know where the money goes. It goes here, there, wherever. So that may give us more transparency in how much money is being spent between certain classes, certain races. So, but that just goes to show, like, digital is here to stay. Like, you need to get on the technology front as far as when it comes to currency. Believe it or not, I actually had some shares in Square when I first started investing 2 years ago.
Oh wow!
And I bought it. I was buying in. It was like at $90 or something like that. I didn't know anything. I was like, man, and I saw it dropped and then went up a little bit. I'm like, I'm getting out of this. I think at one point it dropped to like a low of like $60 or $50. I'm like, yeah, I ain't messing with Square. I'm done. I'm off that. And
you regret it now?
Of course I regret it. Square stock is trading at $208.15 a share. Yeah. And even if you look at like Square, Square even first came into fruition in 2015. That's when it was being traded publicly. I mean, it came to fruition before that, but it was trading at $12.85 a share when it first started, and now it's at $208.15. That could have been another stock that millennials probably got rich off of, and whatever it may be. And that's also what I'm kind of hoping on too now. Like, it seems like stocks and investing is so it's getting popular now. So, not saying that's a bad thing, but it's like I'm not trying to buy a company at $70 a share just because they know that it's popular now and people are just gonna buy it just so they could be in on it. Like, I wish we could go back to prices of like when Facebook first went public. But you know, it's the future. The future is closer than we think. It's literally staring us in the face. And one thing, back to the central government involved with the digital currency. So you have your Bitcoin and so forth, and Facebook, they have their Libra coin where you'll be able to use it on like the Facebook platform. And Facebook, they actually own WhatsApp, and they actually rolled out like a payment system through WhatsApp in Brazil that they're using, and then the Brazilian government got a hold of it, and something happened with it. I'm not too certain.
Oh wow!
But Facebook could be a chance for us to get in on next year, because the Libra is supposed to start using Libra on their platform. So if there's like another correction in Facebook and it drops below the $200 price, I'm probably gonna try to jump in on Facebook. Facebook ain't going nowhere.
Tap in.
Yeah, and
they're not trying.
I also want to talk about PE ratios. I finally understand them to an extent, like, because there's multiple ways to look in. Like, you have like the PE ratio, price to earnings, like the price you pay for what they earn.
Slow it down, man. Slow it down.
And then there's like the forward PE ratio. Then there's the trailing PE ratio. But basically, the PE ratio is a good gauge to like how healthy a stock is, like whether how much risk is involved in it compared to like the downside of it. Like, so I guess the upside compared to the downside. So basically, overall your risk. So analysts, they like to say like a good PE ratio is between 10 and 16 for a company. And I think what I've seen with like the tech companies, their PE ratio, I think they're healthy too, because they're tech, they're here, everything's tech now, and their PE ratio is usually double what's a healthy PE ratio. And so, for instance, right now I'm looking at Facebook, it has a PE ratio of 33.17. So basically, you're paying $33.17 for every dollar that Facebook earns. And when you compare that to something like Tesla, Tesla gets all the craze. We all wish we would have got some Tesla, but you win some, you lose some. That's what losers say. But so don't even worry about that. There may be another chance of buying Tesla. They did a 5-to-1 split and it dropped down to like $100 something a share. And now Tesla's trading damn near $600 again.
Unbelievable.
But Tesla's P ratio is almost $1,200. So basically, you're paying $1,200 for every dollar Tesla makes. Now, who in their right mind can honestly afford that? I don't believe in that company that much to pay that much for it. I'm going to buy 10 shares of Facebook for that $1,200 compared to buying one share Tesla with the chance that Tesla might just pop and explode tomorrow, whereas Facebook may pop, or Tesla is pop and down and go on the downside tomorrow, where Facebook might go up. I'd rather pay the $33 for every $1 Facebook earned compared to paying $1,200 for every $1 that Tesla earned. Like, so that's one thing that you all should look at when you're looking at a stock, the PE ratio. That's usually a good symbol as to saying how healthy a company, how healthy it is to buy a company at its set price. PE ratios.
Also, don't forget about, I don't know if you're familiar with the term, the RSI. I feel like a lot of people, if they paid attention to that, then they probably wouldn't get burnt when they were hearing about these stocks like trending. It's basically, it stands for relative strength index. And to my knowledge, what happens is once you go on whatever platform you go on to research the stock, it'll determine if something is overvalued or undervalued. You use that RSI to determine. Obviously, you can't time the market, but that gives you a better idea of when you're purchasing something, or you have purchasing a stock at a certain time, if it makes sense. You get what I'm saying? Of course. What'd you say?
That makes sense. That makes lots of sense. Like, I'm looking right now. Like, I looked at the Tesla one, and there's this website called finbox.com.
You quick.
They say Tesla has the RSI of 73.87, and it says that the company is trading technically in overbought territory. People have bought too much into Tesla. Like, you're paying too much. It's too high for what it's actually worth. Whereas now I looked at Apple, and then they're saying their RSI is neutral. So it's right. You can buy into it, you could sell it, whatever it may be. So, okay, relatively strength index. I like that.
You know what it is? See, now I taught my cousin something.
You did.
Yeah, I only learned that because what happened was when everybody was going crazy. I know we had an episode where we talked about that too, about the Apple stock. And basically a lot of people bought it, were buying at the wrong time. Well, not just say necessarily wrong time. I guess dollar cost averaging, you'll still come out in the long term, you'll benefit. But they could have purchased it earlier at a lower point. But because now they heard about the split, a lot of people were purchasing, for the first time, shares of the stock. And, it was really hot at that point. I feel like it was a strategy in a sense too, with Apple, them splitting that stock. It basically provided an illusion to some people that was like, okay, so now it's on sale, but it's really just surface level what it looks like. It's still split, but it doesn't change the value, you know what I mean, necessarily of the Apple. Although people seeing it at $100 instead of $400 is probably did jump the value once they started buying up shares and shares of it.
I will say this: when I first bought Apple, I definitely bought it when it was overbought. But when you start doing researching, due diligence, you start watching certain TV segments, listening to certain podcasts. You listen to analysts all the time, and what I'm starting to realize, a lot of these analysts, not saying that they're wrong, like they definitely do the research and they read graphs and charts, but ultimately nobody knows what the market is going to do. A lot of the research just comes from past historic events, past trends that, okay,
Yeah.
so here, this is what it's going to do.
Oh, my boy whipped out the pen.
The market behaves a certain way. So, and like you hear him say, oh, Apple's right now, it's not going to go this high. It's not going to go that high. Throughout the whole year, last year, people were saying Apple is not going to hit $300, not going to hit $400, and
Right.
but at $500. So it's like you could only take so much of what somebody says, and you also gotta like trust in what you believe may happen or what you think's going to happen, or sometimes what your gut may tell you. I mean, you may lose and you may win, but overall, it's still your decision at the end of the day. And a lot of these analysts, they just give you insight based off the research that they do. So like a lot of these people, the podcasts, like I've heard people on podcasts and their segments on YouTube, whatever it may be, say, yeah, we don't business in buying into IPOs or nothing like that. And then like 2 weeks later when or even like, let's say for instance, like a month or 3 months later when the earnings come out for that company, you hear the same person who say we don't buy into IPOs say, yeah, we bought into that IPO and look how we're doing right now with this company. It's kind of like, so you say you don't buy into IPOs, but you bought into this company when it went public, and now you're doing really well. And I based my decision on what you said, and I truly thought that this company is only going to go up. And based on what you said, I'm like, you know what, I'm not going to buy into this company. But you do hear these people say, like, they're not financial advisors. So
they do put their disclaimers in, yeah.
So but also, so you just got to, like,
research
yourself and do your own research. And like I said, I always, like, people, when I was buying into Apple, they're saying, yeah, Apple's not going to get there. And look where it went. So same thing people said with Tesla. Like, that's also why I didn't buy into Tesla. People saying, yeah, Tesla is overbought. Like, why are you buying into Tesla? If I had the money to possibly buy like 10 shares of Tesla when it did display it, or even last year before it was even trading at, like, when it got to like $1,400 a share, and I could have been up. I could have had 2 knapsacks over my shoulder now. But I was like, nah, it's just fake. But and now you're seeing companies, they're like I said, they're trading at all-time highs. Me personally, I'd love to see a correction. I got some bread on the sideline. It's not crazy, but I want to buy in and just look at the gains long term.
Also, you can't forget, people gotta keep in mind that once again, we're not experts, we're not gurus of any nature. But what I will tell you is, especially for people that are just getting into investing, try to keep your risk as low as possible. So just because we're thinking back in the past, like, I should have got back into this stuff, that doesn't mean that you go for something as a rash decision, like, maybe on the hopes that maybe this might be the one that'll jump up. That's gambling, essentially, And to simplify it too, just like what you were saying earlier, because about how the stock market and the analysts say this and that, and then when it comes out, it's completely different. Just to try to, simplify it for other people. Let's say people that are into sports, they have fantasy football. I don't know if you're as familiar with fantasy football as me, because I'm in fantasy football. But you draft a team, right? And you have all of these different players, and basically based on how they perform on the field is how much points you get week by week basis from those players. So you have to strategize who you think is going to provide you the most points as a quarterback, running back, wide receiver, kicker, and defense, tight end as well. And basically you're going week by week against different players, trying to determine if you're going to win based on performance. And I say all this to say, Tom Brady might throw 3 touchdowns and 300 yards last week and then play one of these teams. Like, I remember they lost to the Bears, I believe, the Bucks. And I know, right? But they're on like a 2-3 game losing streak right now. I think they've lost the last 3 of their 4, something like that. But anyways, I say all of that to say, Brady will have a big game like that, right? Get you 40 points and then get locked down by another team and provide you 10. You you're just going with your best choice. Obviously, that's just breaking it down, simplifying even more. There's more factors. Anyone that's into statistics or probabilities into the stock market than fantasy football. But it's a similar concept in the fact that even if you trust that Tom Brady, who is a solid player so far this season as far as points, I'm not going on if he threw a couple of picks. If he threw a lot of yards and he got me some touchdowns, he did good for me. You get what I'm saying? But he can be injured. Boom. That's messed up. He is 43. That's another factor. Depending on the team that you're facing, he might perform differently also. So I say all of that to say, to go back to the stocks, you have to do your research and choose what's your best decision. You can't just go on a limb, because the same way when it comes to fantasy football, or it comes for you trying to weigh who has a higher chance of doing this or that, it all comes down to a mixture of sometimes luck, but research. But
that's kind of like when people say hedge your bets, or like let's say you are investing in Tesla and you see it's going up, and finally, like, you know what? I'm gonna take some of my profits because this thing is running up too much. I'm gonna place a bet, put some options in that the stock is gonna go down. Basically, I'm gonna take some of my profits that I made from this stock, some of them, and put it back against the company that is gonna go down. And it just so happens that I just knew it was gonna go down just based off the prices it was hitting and just the way the market was. And now that bet that I put against it going down, I'm making profits off of that too. So not only did I sell to get some of my profits, I also bet against it, and I'm making profits on that too. So yeah, I mean, it's some things are just it's well calculated risk. So, but yeah,
that's what it comes down to too. How do you feel about index funds as a whole? Do you invest in index funds a lot?
I do not. I should. I want to just get like a
keep it boring, man.
Just
keep it boring. That's what a lot of people say, is like when you do something steady, something keep it Warren Buffett. You know why? You said you like Warren Buffett. Why aren't you doing these index funds?
Warren be buying whole companies.
You got a point.
Warren be buying whole companies, but yeah, I mean, there's this one thing that Warren Buffett said. It was about Coca-Cola. It's like if you bought if you bought a share of Coca-Cola when it first went public in 19 blah blah blah. Now that company is trading, and with your dividends reinvested and the growth over the years, you're now a millionaire based off of just that one share and the continued reinvested dividends. So. Well, I mean, like, yeah, that's basically, I do his method of investing, just buy a company, reinvest the dividends, and let it do its thing. But the whole index fund thing too, I get that too, but I would like to just get like a regular S&P 500 index fund and just put into it weekly, whether it's $10, $50, $100, and see how that do. But I just haven't done it yet. I plan on it, but I will eventually.
You on the individual stocks right now?
That's what I'm doing. But you know, eventually I will get into the index fund. I do have a position in like emerging market fund. So I was listening to something the other day too. Apparently it was saying there are more billion-dollar companies outside of the US than in the US. And yeah, and then apparently like 75% of the top rated stocks that perform every year are also outside of the US. Wow. Believe it or not. Yeah, I was like, what? Get out of here.
Do me a favor, please. Get out of here. Get out of here, man. I'm saying.
Get out of here, man. You're the enemy of the state. But yeah, and so I do have like an emerging market fund. It's nothing. I literally only have 3 shares in it. It's nothing major. I always tell myself, put $40 a week into it. Put $40 a week. I have yet to do it yet, but it's one of the top performing parts of my portfolio. So I need to emerging markets. That's another good thing to get into. I mean, I will never bet against America. America is beautiful, great. I know we have our skeletons.
What you getting? Wiretap, bro?
I know we we have our ups and we have our downs, but sometimes you gotta sometimes you gotta look on the other side. They do say the grass is greener on the other side, but
Right.
you
As
just
much
can't
as
put all your eggs in one basket, as some would say. So some people get away with it and do well, some don't. It's good to diversify, put things here, put things there. I mean, the way I see myself, I envision myself like having a property somewhere overseas. So why not invest in companies overseas? So
that
we'll see.
makes sense. That makes sense.
But, they have economies that are flowing like ours. They may not thrive as well as the U.S., but some thrive better. I mean, and even now with like the whole lockdown and coronavirus, now we have hopes that this vaccine's coming out.
That could be some
You
info.
have countries, mainly in Europe, where they've actually they locked down the country, like people weren't doing anything, and some countries now they still have curfew. But we live in a beautiful sunshine state, and we the bad boys, the wild wild west.
Florida
We do
man.
what we want to do. We don't even have to wear masks if we don't want to. But
Mhm.
you're seeing these countries now that are starting to come off of their lockdowns, and that might be a good chance to invest into some of these countries or stocks that are based in those countries and see what happens when their economies start to come back. But it will all have a trickle down effect too, uh, with countries' GDP, with them not being able to produce anything for such extended period of time. Uh, People, even like the littlest thing, like people not paying rent to landlords,
Mhm.
so and you'll see a trickle down. Maybe it will lead to a market correction, but I think what we realized since panoramic started,
You said the panorama.
uh, uh, the panoramic.
It's a panoramic. We need our money. I don't got that kind of time because it's a panoramic. Okay?
Started, you see that the stock market is disconnected from reality. Like it's its own other animal. Like it
Listen,
has
what they
nothing to do
say,
with the economy or anything like that. So
and people need to understand that if that hasn't taught you that before, you should see now. We do not mirror the economy. We need to
no,
stop saying
the,
that. Literally
so,
showing you.
so basically, like I'm saying, the stock market is hitting all-time highs under another lockdown throughout parts of the world,
This is the major.
and people unfortunately they can't invest in it because they can't even pay their rent and like that. But it just goes to show like it's a complete different vessel. Like it's own ship. It's own Mount Everest. So, and you can either hop on it and try to get to the top, or just sit aside and just watch other people reach the peak. So, speaking
Exactly.
of peak season, FedEx and UPS, all the parcels starting to ship. FedEx is probably about to crack $300. I vividly remember when FedEx hit a low of like $80, maybe about like six months ago,
Wow.
and I was like, yeah, I'm not gonna buy into it. I should have. We all should have.
Man.
And look at it now, about to crack $300.
They're eating good.
So, but I will say this: it's wild that the panoramic. Let me stop. That the pandemic. It's wild that the pandemic has it kind of saved a lot of industries. It it hurt a lot, but it saved some. Like FedEx, because usually during the summer, FedEx is a slow company. They don't really do nothing. It's not nobody shipping gifts to anybody, just normal operations, blah blah blah. But with the panoramic, there's a whole influx of people. The e-commerce, like it's through the window, through the roof, or any analogy you could think of that's absurd. That's what it is. And also, FedEx actually bought a company called ShopRunner, which is an e-commerce platform that basically connects consumers to companies to get products easier, something like that. FedEx bought that company, so you still have companies doing mergers and acquisitions during the pandemic, and this just goes to show that it did not stop. The e-commerce is here to stay, and it's going to continue to grow as more people continue to spend their money online and just not some big box retailers. Like we're gonna have our retailers like your Walmarts and your Amazons and Target and whatever it may be. Like brick and mortar isn't going anywhere, or even the warehouses, like the fulfillment centers, I should say, they're staying. But it just goes to show, like when people want their goods, there are systems put in place to get their goods. I learned something the other day too about FedEx. So FedEx, somehow they like save on their taxes because they're considered an airline company, not a shipping transportation company.
Wow.
That's how FedEx save some money when it comes to the thing. They are actual airline company. So you have FedEx Corp, and there's so many different facets under that umbrella that trickle down and do different things throughout their operations. The FedEx solid company. I won't ship another package with anything else. I'll mess with the USPS. I'll mess with UPS, FedEx all the way. FedEx all the way. But so
pricey, you know what I'm saying?
Yeah, a little pricey, but the price you gotta pay sometimes.
All right, cuz I appreciate that. Anything else you want to share before we close this out?
Start investing. That's start whether you have whether you have $1 or you have $100,000. Start investing, because eventually one day it will grow, and you want to build wealth. You want to, even if God bless my sinful soul, God forbid something happened to me, I'll be able to leave the coins I have to somebody, and hopefully they do right by it. So just start investing.
Dave Chappelle clip after that. Hopefully they do right with it. I'm rich. My reparation.
Start investing. Don't sit on the sidelines. If you start investing and the market continues to surge and it hits 40,000 before it has another correction, which I doubt, just start investing. Because even if you start investing and it happens to have a correction, I believe you're investing at one of the best times. Like I told Shamar, like he started investing at one of the best times. The market was going up, it was going down, it was going up, it was going down, up, down, up, down, like a cheat code. And I think that builds like it gives you a strong mentality how to like withstand certain downturns. And you just understand, because like when I first started, like I think it went down some and I was like, oh, okay, then went up and I was like, and I sold some stuff. But now like it happened again, and like I noticed I like used it as a chance to rebalance when I bounced back up. And I was like, I'm in companies that I really know nothing about. I really just bought it because I heard somebody say buy it. And once it went back to a positive and like I had a little profit on it, I got rid of it. I'll pay my little capital gains tax at the end of the year. But if it's not a company I know too much about it, I don't care too much about, and it's just something I don't understand, I'm not gonna get into it. So you just gotta do your due diligence. Even just start investing. That's all I have to say. Just start investing. If you want to buy the big box, if you got the bread to buy the big box things, just be careful. You don't want to pay premiums for these companies. Make sure you look at that PE ratio. That's going to be your best friend. One of your best friends. Yeah, the RSI. Look at that. So those little things creates a solid foundation to what you can create for yourself. So just start investing and just watch your money work. Because even if you work your part-time, I'm not gonna even say little, because right now having a job is a blessing. If you work this job or you have your company and you do this, like I said, if it's even $1, $2, $5, $10, $100, invested. That's all I have to say.
I agree.
Because your money is making more. Seeing your money work for you is amazing. And then when you see it start to compound, and because compound interest, eighth wonder of the world. When you see once you see and understand compound interest, you're just like, wow, okay. Like I've started to see it with certain companies. Like I bought into a company, and then like the dividend comes around, I reinvest the dividend, and then keep buying into the company, and then dividend comes down, and then I get more shares. I'm like, oh shoot, this dividend's increasing. And then when you get to the point where like your dividends start buying whole shares of company, you're like, all right, I did this. And that's when your money really starts working for you. Then that just starts, and like that company does so well, and then that year it returned more than 30%. Then you see that 30% grow on the dividend and what you've been putting in. You're just like,
I got it.
round of applause, baby, make that, and you good. So, like I said, just start investing, play guitar, drive cars, whatever you like to do. But yeah, so that's my little 1-2. Start investing.
I appreciate the 60 minutes, cause
yeah, it's all good.
Well, once again, you already know this is RFBM and this is Money Talk. We out of here.
Yep.
Our own mind has to be changed. We have to change our mind about ourselves.
Instead of me fulfilling my prophecy, I have to start. Instead of me, doing a good job and carrying on the empire, I have to build. And that's a hell of a job with 21-year-old. You know what I'm saying? That's a hell of a job for any youngster, male or female, to have to build the empire. Because this world is such a gimme. Everybody back off. Everybody's like taught that from school.
I don't come to bow, I come to conquer.